Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's March 7th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Is it me? Or are the Oscars the worst event in the world? I mean, seriously, it's like the biggest no-fun event. And if you think about the big events that you watch, they're all entertaining as hell. I mean, you can go to this Super Bowl. Oh, my, it's great. The granddaddy of them all. You have the Masters in golf. You have the Grammys where you have really great performances and they mix it up. It's fun. The Tony Awards is pretty cool. The Emmys filled with jokes and fun. I mean, I'm not even a fan of country music, and the Country Music Awards are pretty cool to watch. Everyone's smiling and laughing. The Kids' Choice Awards, actors are getting slimed on stage. It's fun. It's entertaining. But the Oscars this past Sunday, I mean, I think even the people who win the awards aren't happy. I mean, maybe it's because they already know they're going to win. And it's the most predictable major event ever, if you think about it. I mean, after Frances McDormand won, did you say, oh, wow, I cannot believe it? Or Gary Oldman, all of them, everybody knew, everyone, every list, they went at the top, every single list. Allison Janney won, Sam Rockwell won. Wow, what a huge surprise. And they kept, oh, I can't believe it. Well, if you would have looked at every single person who takes polls on this and predictions, the whole entire world had that. So you should believe it. You know, they had it for the last 2 months. They knew. Why didn't you know? Hey, you knew. Come on. Well, the only surprise in the past 10 years was last year because they read the card wrong. And that's why when events are unpredictable, you don't know what's going to happen. That makes them exciting. But this, come on. I mean, you can't even get through it anymore. And it's not just the middle part, which has always been terrible for the past 15 years. Right? They'll announce a couple of really cool awards at the beginning, and then, of course, you got the big ones at the end. And then you have to sit there for 2.5 hours. And you just sit. It's you know, I'd rather get poked in the eye 100 times with a pen than watch that part for over 2.5 hours. But now it's boring the second it starts with the red carpet. Red carpet is great. It's the same thing every year, right? You have someone, they'll have a couple people, you know, whatever, doing those little interviews. Oh, look who's coming. It's Meryl Streep. Oh, wow, you're so beautiful. And Meryl Streep, she's the greatest ever. All right, actress, actor. I mean, she basically could make a movie about staring at a wine bottle for 2 hours, and she'll just be sitting there, and she'll get nominated for an Oscar, right? The best actor. She'll win, right? And no matter what she does, whatever, she's always in, no matter what. It's great. But they'll go and say, "Wow, you know, what are you wearing today?" Oh, I'm wearing Dolce & Gabbana, and Meryl will give you that fake smile, like, it's just, yeah. And the host says, well, you just look fabulous. Who cares? You watch the red carpet, it's the same exact thing every year. They ask the same 3 or 4 questions. That's it. And if you really want to make it entertaining, ask Maya Rudolph why she's wearing a turtleneck to the Oscars. I would love to see her respond. And she's cool, she's funny, and she, would probably say something back. That's entertaining. Or Selma Hayek and why she looked like a chandelier. If you put her next to chandeliers, you wouldn't even tell the difference. They dress it. And she's entertaining as hell. She's funny. She would tell you to go, you-know-what yourself. It'll be funny, be entertaining. And you look at guys like Howard Stern. Those interviews are fantastic, right? Because he goes anywhere with them. It's not like scripted or he'll have a couple things and mention a movie that they're in or whatever. But he'll ask them crazy questions that it's fun and he catches them off guard. And that's what makes it cool. You know what you're going to get. Much Fallon on the Tonight Show. You watch all these at night. It's just, kissing up. They just ask like the same question. Oh, your movie. Oh, it's so great. Oh, how your kids, how you feel. Oh, challenge them a little bit. Have fun. It's okay to piss people off sometimes, especially actors and actresses who get their butt kissed all the time. Come on. That's why everybody loves that Howard Stern show. It's so real. Then you have the political agendas still. I mean, you're actors. We watch you to get to get the F away from politics and all the BS. That's why we want to get out of that. We hear it every day. We can't put on a news program today without a complete bias of what side they love and what side they hate and everything and who did bad. We're sick of it. Social media, even our friends comment politics. We hear it all the time. So what do? Well, we turn to movies, we hang out. This way no one has to talk. You just watch it. Now we want to watch it, and it's all political. I mean, you'd think they learned from the NFL that entertainment and politics don't mix. That's why the ratings are the worst in history this year in the NFL. And that's why this is one of the lowest rated Oscars ever. And the best is this event lasted for 4 hours. The fake smile is boring for 4 hours. Is that possible? Do we really need to see who won the Oscar for lighting design? Does anybody care? And listen to their speech, where they thank people that nobody ever heard of, or thank their wonderful spouse. You're the rock, you're the greatest. I wouldn't be. I love waking up to you all the time. And they do this whole entire thing, which I don't know why everyone has to do that publicly these days. I note to self, if you have to say how great your spouse is publicly all the time, there's a 90% chance you have a terrible relationship and you're going to get divorced inside 12 months. And seriously, if they had stats on that, I'm probably being conservative. Because all my friends that constantly are talking, oh, my wife's so beautiful, I can't believe they're divorced. And they're broken up like a couple months later. And you don't have to let the whole entire world know how great your spouse is. Of course, in certain times, in an anniversary, I see it. Great. But those people all the time, oh, you're the rock, you're everything. And then, they'll break up all the time. I mean, do we really need to see the Oscar winner for makeup, for sound mixing? And the Grammys have similar boring categories, which are important. I'm not putting those things down, and I get it. But remember, we're watching something for entertainment. It's important that we have buildings and skyscrapers, but it doesn't mean I have to watch how they're drawing up the plans for 4 hours. It's important. It's very important, but that's not why I'm watching the Oscars. I want to be entertained. It's the movies. And the Grammys, those boring categories, what they did is they took them offline. And they didn't put them on live TV and maybe show like a quick segment of, hey, here's who won here. And they'll do it, better to acknowledge those people. Again, important jobs, but we're watching this for entertainment. And I don't know why I was even watching it. I couldn't get through it. I was like, you got to be kidding me how terrible this is. It's a award show for actors. Entertain us. I mean, the total U.S. gross for The Shape of Water, which won the Best Picture, is $54 million. In fact, of the 9 films that were nominated for Best Picture, the total gross was $1.3 billion for all of those combined, right? And half of that was from one movie, which is Dunkirk. That's the same amount that Fate and the Furious generated by itself last year. And you got to watch The Rock, Vin Diesel, Charlize Theron, Kurt Russell was in it, Jason Statham, fast cars, airplanes, submarines, everything getting blown up. That's cool, that's fun, that's entertaining. And even if there's chick flicks or whatever, I mean, there's entertainment in those. It's fun. It's nice going to these. But when you're watching the award show, this format needs to be changed. It's horrible. C-SPAN is more entertaining than the Oscars. C-SPAN, watching, just people walking back and forth all day, and the votes on the bottom. That's more entertaining. You could start by having cool categories like worst movie of the year. Chances are the worst movie of the year generate a lot of revenue, so they're not going to care. It'll be funny. It'll be a joke. It'll be cool. The best scene, the best stunt performed by an actor. That would be pretty cool. I mean, imagine The Rock winning an Oscar and then his speech. You probably lower the average person who watches the Oscars from 75 to 50 just with that one segment. Instead of having an event where the people who actually love movies, who go to the movies, who pay to go see you, and they watch them all the time. The audience, they have no say who wins or loses these. Yeah, they're the People's Choice Award, and that's why it's exciting, because everybody saw these movies. They're cool. You're getting great actors. If you want to look at this, right? So if you look at the Academy of Motion Pictures, this is a group of 6,000 voting members from 17 branches. And these people get to place votes on movies, even if they didn't see them. I am not joking. They don't even have to see them, and they can place a vote on a movie. And think of how much ass you have to kiss just to get in that group. And man, don't say anything negative. But if you're looking at that group specifically as early as 2012, 94% of that group was white. And 77% were male. And I'm sure most of them were over the age of 60. And then what happened a couple of years ago? Straight Outta Compton, amazing movie. Were they really surprised they didn't get any nominations at all? Which was great because it sparked outrage, and then, should have gotten on. There was amazing actors in that movie. Michael Jordan in Rocky was great. He doesn't get nominated, not even nominated. And you're wondering why? And this group, which is insanely powerful, don't ever say a bad thing about them. If you criticize the Academy, good luck. Because you have zero chance of winning Best Actor. I don't care if you starred in Titanic, Godfather, Schindler's List, and Gone with the Wind in the same year. You wouldn't even get nominated if you said something better. Because it's up to them. It's not up to the people. I don't mean to rant about this, but when I waste 4 hours of my life, which is very, very busy these days, traveling to find your stock ideas, and I want to relax my wife and watch something entertaining, and I watch that, man, there needs to be an overhaul. And they found a way to make regular season hockey fun with 4-on-4 in overtime and then shootouts. They're finally changing baseball where you can't visit the mound 60 times a game on every pitch. Because the average age of baseball is going up to 55, 56 now, and they're losing a young audience, which is important because social media is so huge. When you're posting the last dunk from LeBron James and the last touchdown, all this stuff, people, the kids love this stuff. They're posting it. You're not posting a home run from baseball. Oh, look at this home run. Oh, wow, he hit it over the wall. Wow. You got to make it more entertaining. That's why we're watching. Anyway. I can keep going here, but I won't. If you just completely want to waste 4 hours of your life, watch the Oscars every year because that show makes Keeping Up with the Kardashians look great. That's how angry I was after I watched it. Anyway, let me get off this. Again, sorry for a long rant there. Getting back in the saddle. Really, really awesome podcast for you today. That I promise, because I'm interviewing two guests. I usually interview one, today I'm doing two. The first is John Petrides, Point View Asset Management. Fantastic, awesome. And then we have Rich Suttmeier. The reason why this podcast is going to be so special is because we're really going to detail the risks of the marketplace. You heard from me and saying, hey, there's a lot of positives here. This is what you have. And I like highlighting the positives. I'm going to say this in one of my interviews when everyone's negative. And when everyone's negative, I like to highlight all the positives. Or I'm negative, positive, negative, back and forth. You know what I mean? But it's I try to keep things balanced, right? Because a lot of times I see where everyone's a raging bull in technology, and I'll say, guys, be careful. There's a lot of underlining things here just to keep things balanced. It's important. What these guys are going to explain to you today is what's going on, why it's important with Cohen resigning, why it's important interest rates are going higher, why is it important with possible trade wars. And it's not going to be explained on a level where you need to be an economist or something like this, but they filter it down to where you could see and be like, wow, I see why this could be a big risk. And they're both fantastic. And we're going to start out with John Petrides, and here's that interview right now. John Petrides, thanks so much for coming back on the podcast, bud.
Thanks for having me on, Frank. Love doing the show.
I like to have you on once every quarter because, I look at your stuff. You're on all over the media. It's just and I think it went a little bit longer than expected, so I kind of missed you, man. I have to tell you.
Well, listen, I listen to this show weekly, so although you and I have not spoken on the phone, I feel like I hear from you every Wednesday and Friday.
No, that's awesome. Because you're one of those guys that we can go anywhere with this conversation. It's not like market specific, industry specific, whatever. And that's important today, right? Because we saw in February, and the reason why I love this and I wanted to talk to you so much is because I saw what you were saying, and not a lot of people were saying this in February when the market came down. We see a lot of stories, a lot of panicking, which is normal, right? I mean, it's normal because we're comparing that to what? Not the last really correction. It's been over, like 18 months. But, you get these fears in the market where, it's another credit crisis. And I saw you come out saying, look, guys, this is a buying opportunity. Just stay focused. Yes, we're a little overvalued. It's kind of like, that calm that I like to see from people instead of everyone going, the market's going to crash 30%. What did you see back then? And I want to translate it to what we're seeing now because now, we're having a lot of risk more in the market. We're seeing the market start to pull back again. And I'm starting to hear from people that are getting nervous.
Right. So I think when you take a step back, you look back at 2017, and stocks really had a fantastic year. And I think the big risk that was introduced to, or I guess reintroduced to investors in 2017 was complacency. The S&P 500 finished positive every single month in 2017. And you really had no period of excessive volatility. You had a little bit with Syria on the geopolitical side, North Korea, Syria. That brought some nervousness into the market. But by and large, the market went up and to the right. And the risk that creates is it forces or it allows investors who shouldn't take on risk to loosen the screws and go a little too far out over their skis to invest in certain investments and or stocks that they normally would not do. And I think what you saw in February were a lot of people caught off guard because the market had been so calm for so long that once volatility was introduced into the market, people just panicked and hit the sell button. And we always live by the line that Warren Buffett puts out, and that is, be fearful when others are greedy and greedy when others are fearful. So we hadn't seen volatility into the market in quite some time, and because we think the underlying fundamentals are so positive on the macro side and on company specific side, we saw that as an opportunity to buy really high quality companies at cheaper prices.
Now, translate that into what's going on with the market today, right? Because, we can go over a lot of positives and we hear the positives, and the reason why I highlight the positives so much, even in my podcast and even in my newsletters, is because when I feel that people are fearful for the wrong reason, I'm like, hey guys, listen, there's a lot of great things in the market. And the same goes true when the market's really high and I feel like it's overvalued and everybody's really positive on it. I'm like, hey guys, look, these are the things you got to focus on, because not everything, I try to balance it out this way everyone knows the risks, the reward. But now we're seeing another set of circumstances where possible trade wars, right? I don't know if that's getting really out of hand right now, and you've seen this story how this could really be damaging. For me, and we'll talk about trade wars before we talk about Cohen resigning, but when I look at the trade wars, I think when you're the biggest country in the world, most powerful country in the world, right? And we see people taking advantage of some of these things, which have been happening for years, and it has no accountability, right, when it comes to politicians. I don't agree with the way it's been handled, but I think you could say the same message, like you said, with steel tariffs, because we've seen China imports decline significantly, and I've done a lot of research on this, ahead of this announcement, because he's been warning about this since he's been elected. So you could get the same message across and actually doing this. What are your thoughts? Is a trade war something we should worry about? Because for me, I look at other countries, for them to do what we're doing and increase their tariffs, they're not on the footing that we're on. They're just coming back. Their markets are better right now, but I think they're more fragile than we are, and that could be really damaging to their economy, much more than it would hurt us if they decide to retaliate.
Yeah, so I think two things are going on. There are two issues that have injected volatility into the market. One is inflation and where are interest rates headed, and we can talk about that in a second. The second one is headline risk around tariffs and trade war and things like that. And I think that's all it is headline risk. I don't think this turns into a full-scale, blowout where, where other countries retaliate in such an excessive way that it cripples the global GDP, the global economy. No one benefits from that, okay? So I think this is more Trump and his administration pounding their chest, just, sending the message that, which is what he has built his entire agenda on, that the U.S. is not just going to stand idle anymore to the global, to other countries. So whether he acts or not, it really all depends. I think time will tell. I don't think much comes of this. I think Congress still has a check and balance on him in terms of passing tariffs. So, and at the end of the day, tariffs are not good for the overall economy. I think they do protect certain sectors and industries. But at the end of the day, if Ford has to pay more for steel, they're just going to increase the price of the Explorer to you and I. That's basically where it's going to go. It's going to get passed through to you and I, and taxes are never good for economic growth. So, at the end of the day, there was an investment strategist that said this in Barron's, I think last week or the week before, Trump's ultimate opinion poll is the stock market. So if volatility picks up in the market and stocks sell off and values of companies go down because of a negative reaction to tariffs, he's going to listen to that more than anything else.
Now, you brought up an interesting point with Ford. I want to bring the audience in here, where you said, okay, now say if they have higher tariffs, that's going to result in higher steel prices. Higher steel prices, what's going to happen? Obviously, it's going to be passed off to the customer. When it gets passed off to the customer, these are all inflationary trends. And let's go to the next step of what people are looking at and why they're nervous about this. So now we're seeing inflation rise. and it's still considerably low when we look historical, but it is rising, and the whole world knows it's rising. So I like the fact that that risk is on the table. It's not a surprise. But when you see things like this, where we're having tariffs and possible trade wars, that's what we're looking at, higher inflation. And, talk about that, because that's a great point where people are like, well, why is the market going up? Why is this such a big deal? And you're explaining it, which is cool. We just have to finish that part off because it makes a lot of sense.
Yeah. So let me bridge the 2 points. Let's not forget, too, we are in the first week of March. There's 3 weeks left to the end of the first quarter. And, earnings season, which was stellar, by the way, you had about 75% of the companies in the S&P 500 beat analyst expectations, not only on earnings, but you also had a big beat on the top line. So corporate America did a fantastic job, in terms of results for this upcoming quarter. So what you're having is, if earnings season is over, you have two things that are driving the market. One is upcoming Fed policy, or upcoming jobs report, and how that's going to impact the Fed policy. And two, you have trade wars here that's stealing the financial news, and it's driving investor sentiment because earnings season is now over, right? So now you have the headlines that are going to push the market around a bit here. Okay, so let's bridge into inflation and interest rates, because what really set off the volatility that we saw in the beginning of February was the really very strong jobs number, where we had 195, 200,000 jobs, but clearly it was the wage growth that spooked the markets, in that we had wages expand at 2.9%. Remember, again, go back to complacency. The labor market has been very tight. We've been below 5% unemployment rate for 2 years now, and wages have hung around growing between like 2.3 and 2.6% on an annual rate. With the economy that tight, with the labor market that tight, you would expect that wages would have risen faster. Well, here we are in February, and boom, you have wage growth go up to 2.9%. So, and that's really what set off volatility, because then you saw a spike in bond yields, and, all of a sudden the market starts, pricing in, the U.S. is going to look like Zimbabwe or Argentina or Venezuela, where, inflation is 5,000% on an annualized rate. We're nowhere near that. We're just, expectations got a little too complacent. So I think what you're seeing now is, this is Wednesday the 7th. This Friday you have the jobs report coming up. And, I think your listeners should be ready for and prepared for potential more volatility to the downside in the market. If we have another strong jobs number and wage growth goes to 3%, 3.1%, the expectations for the Fed to do 4 rate hikes in 2018, when we came into the year with the expectations of 3, is going to increase, and stocks in the short term, I think, are going to sell off. If wage growth moderates, goes down to 2.8 or 2.7 for some reason, stocks are going to take off, because then that will signal that the Fed will be on a more measured pace. There will not be this need to or fear of higher rates and a faster pace, and the Fed can continue on their gradual manner and telegraph their moves to the market. So I think this upcoming Friday, you're going to see a significant amount of volatility in the market, potentially either to the upside end or downside.
Now let's get into this a little bit more, because there's fascinating things there. So, we're looking at the markets. And by the way, while we're doing this interview early Wednesday, guys. It's going to get published at 5 p.m. later. And I just saw the ADP number came out, and it was red hot. So, we're expecting, like you said, it's going to be another great number. We're seeing inflation go higher. A lot of people are expecting it, but it could go higher even now with the trade wars and everything we just discussed. When you're looking at interest rates going higher and the Fed raising rates, there's huge ramifications, right? When you're looking at the stock market of allocation, because we looked at a sector that I wouldn't say I've been so wrong on, but been warning about when it comes to consumer staples. Consumer staples are great, but right now they're not growing sales as fast as they did. A lot of them are trading at 20 times plus earnings, forward earnings, and you're looking back and saying they usually trade 14, 15, 16 times earnings historically. Why are they so high? Because of the yield. And that was the best place. Everyone was seeking yield. But now it seems like we're going to have alternatives if interest rates still go higher, where if that risk comes off the market and people think, well, McDonald's is safe and, Procter & Gamble and General Mills, and these are companies I use all the time, and they think they're safe, but just like we saw with the housing market, right, John? I mean, the housing real estate is a great investment, but not when it goes up 25% annually for 4 straight years when it's supposed to go up 2% annually. We've seen massive moves in these stocks over the past 4 or 5 years. Is that something we need to worry about? And let's talk a little bit about yield, because there's going to be a lot of opportunities, especially for income-oriented investors, right?
Yeah, so a couple of things. I'm actually, next week I'm going to post a published commentary that I'm writing now, and it's basically, stocks can rise in periods of rising inflation, rising interest rates. So, Frank, go back to the late 70s, early 80s. Remember, in the 70s, when inflation was running out of control in the U.S., Fed Chair Volcker did everything essentially through the kitchen sink at the inflation problem and raised interest rates. So at one point, the Fed funds rate, get this, if you're your younger listener, your older listeners, your veteran listeners will know full hand what happened back in 1980, 81. The Fed funds rate was at 20%. Remember that everyone, the Fed funds rate right now is what, 1.25%, 1.5%? The Fed funds rate was at 20%. Good luck. The interest rate was to buy a mortgage. Good luck. Okay, it was. Volcker was out there to squash inflation. Okay, and he did everything he could. Guess what? In 1979, the Fed funds rate was about 8%. By 1982, the Fed funds rate had touched 20%. During those 4 years, the market was the S&P 500 was only down once. It produced a positive return every year. Only 1981 did you have a negative year. Put that in context. That's amazing, okay? Here we are crying about and worried about, the Fed may go up another 25 basis points more than expected. The market's down, 1%. Think about that. We had a positive return from 1 year. Frank, go back to the 2004 to 2006, okay? Greenspan kept interest rates very low to help the economy out of a very nasty dot-com bubble recession and post 9/11. Okay, he kept interest rates at about 1%. Go to June of 2004. All right, the baton gets passed from Greenspan to Chairman Bernanke, and Chairman Bernanke and then the Fed go on a path from June of 2004 to June of 2006 of raising the Fed funds rate from 1% to 5%. So in a 2-year period, okay, the Fed funds rate went up 400 basis points. All right, that's a big move in a 2-year period. And stocks, the S&P 500 over that time period, have had an average annual return of almost 11%, 10.9%. Right. So my point is, if the underlying fundamentals of the economy and or stocks are healthy, even though interest rates rise, and that's going to cause more volatility to the market, stocks can still rally. So that's what gives us more calm and confidence to use the sell-offs as buying opportunities of very, very high quality companies. Now, let me pivot to your comment on the consumer staples and those stocks that investors have embraced over the last 10 years as bond surrogates, right? The last 10 years, retirees in particular have been starving for yield. We've had this massive wave of the baby boomers now coming into retirement. Post-2008, their portfolios were walloped. They're nervous as heck because they're saying, oh my God, I spent all my life saving, and here I am, and I can't even live off the fruits of my labor here because I can't earn enough yield. I have to go out the risk spectrum. I have to take on more risk, own more stocks, which just went down 40% because I have to live the life that I want to live in retirement. Okay, so what do? They embrace, Coca-Cola, McDonald's, these mega cap stocks with low beta, which means low volatility relative to the market, that pay a 3% dividend yield or better, and they've had a history of growing that dividend 8 to 12% annually over the last 10 years. All right, so here basically what investors were trying to find was that growing bond fund, right? That bond where, what is a bond? A bond is fixed income. The problem with it is your income is fixed. So as inflation rises, you lose your purchasing power on the bond. So they want a a bond-like stock, something that doesn't move very much, but has a nice yield, more than they can own in a corporate bond or a government bond, and that dividend yield can grow over time because the company rewards shareholders by returning cash by growing the dividend. Okay, so those stocks, and I know you've been warning about them for a long time, have really increased in value. Investors were paying a 10, 15, 20% premium to the S&P 500 on a price-to-earnings basis, price-to-sales, whatever metric you want to use. Those big mega-cap stocks, consumer staple stocks, were getting a big premium to the market for their safety. And, man, a lot of them have gotten walloped, over the last 2 months since the start of the year. The utility sector, the telecom sector, the REIT sector, consumer staples, those have all underperformed. Those sectors where the market has embraced them for their dividend have really sold off high and hard because of higher interest rates. Right now the market is saying, well, if I can get 3% on the bond, do I really need now because yields are higher? Do I really need to overpay for these type of companies? Now all of a sudden with higher interest rates, fixed income becomes a better competitor from an investment standpoint.
Now, what is some of the, yeah, that's I love the way you explain that too. It's very simple. It made a lot of sense. And when you look at other areas that people invest in, because I know there's a lot of people out there and have these stocks in their 401k, they probably don't even know it. And they've done fantastic on it. But what are some of the investments now? Because remember, guys, it's not something that you buy and you hold forever. A lot of you've seen like the biggest, but there's a lot of rotation. When things change in the markets and as factors change all the time, the greatest investors in the world are going to shift their money around into things that they think are going to work for the next 12, 18, 24 months outside of all the algorithms and high frequency traders. So if money does flow out of this, I know you talked about other high yielding investments that make sense. What are some of the places that you think it could rotate into?
Yeah. So again, I would point your listeners to my chief investment officer, David Dietz, at Point View. He recently just penned a commentary, Post-Market Bargains, and his argument was exactly on this topic, that those bond-like stocks have sold off hard. And the income sector we really think is attractive is the REITs, the real estate investment trusts. We don't invest in private REITs, but the publicly traded REITs, right? So what is a REIT? REIT is a company that owns an office building, maybe a distribution center that Amazon uses, a data center, some sort of building, a healthcare facility, some sort of building where the tenant pays them a rent and they own the hard asset, okay? And they clip the rent, and they're required by the IRS to 90% of their net income in the form of a dividend. So historically, REITs have been a very good place for investors to pick up yield. Now, obviously, the REIT sector got decimated in 2008 and 2009 when real estate collapsed, and they had a lot of leverage, and we all know that story. But that sector has become very, very attractive. The Fidelity REIT Index Fund, just to use it as an example, I think is down about 11% so far to start the year, with the S&P 500 up, I don't know, about 2%, depending on the day, 1.5%. And you're getting, dividend yields, 4.5%, 5%, 5.5% in the space. Now, REITs do have their warts. No one's overly excited about a mall REIT right now. Strip mall REITs, with what's going on in the e-commerce world, and you're seeing popped up vacancies, that has hurt the sector. And if you look at some of the malls, man, they've gotten destroyed. But other parts of the REIT market, the healthcare REIT space, with the boom in the seniors in baby boomers and the elderly moving into skilled nursing facilities or senior housing centers, those stocks have sold off really, really hard, and those yields are quite compelling. So there are parts of the REIT market that I think are very, very attractive. Not only that, in an inflationary environment, if you own a hard asset like a building, yes, maybe in the short term you have some vacancies, but that asset is worth something and can be monetized. And, in an inflationary environment, that's going to go up. So right now, I think the REIT space is extremely compelling from a valuation and a yield standpoint. No,
it definitely makes sense. Now outside of the yield industry, so I want to close this up here. what are some of the things that people love when you come on, because you look at all areas of the markets, everything? You always give us great stock ideas that perform well. What are some of the things that you're looking at? Maybe, we talked about yield a lot. We talked about conservative income. We talked about bonds. Other sectors that maybe people aren't paying attention to, or something even like technology where you might still say, hey, you know what, the earnings growth is there, the sales growth is there, and that's going to continue that momentum. What are some of the things that you're seeing maybe from a sector and maybe a couple individual stocks that you like?
Yeah, well, ironically, tech is the one sector that we're a bit cautious on for a couple of reasons. Right now, the market to us is pricing in that tech can do no wrong and no other sector can do right. I mean, Frank, if you look at the S&P 500, tech is 25% of the index. Now, tech is not 1999. Many of these companies now clearly are mature. They're generating cash flow. They're actually generating actual earnings. But the tech sector is getting to be crowded, in our opinion. And although we have representation for our clients, we typically equally weight our sectors for our client portfolios rather than making a one big sector bet. But if there's a place that we find value, there are two. One, I think, is healthcare. I've been a fan of healthcare. We've been a fan of healthcare for quite some time because the long-term story of a growing and aging global population is not going to stop. And as we all live longer, I think we're all going to utilize the healthcare system more. So, if you want to combine those two themes, one of the stocks we like is Ventas, VTR, Victor Tom Robert is the ticker, and this is a healthcare REIT. It is a REIT that owns and manages senior living centers, skilled nursing facilities, and assisted living and some medical properties. So here you're getting over a 6% dividend yield, stock that's off about 18% or so to start the year, in a sector where we think the long-term fundamentals are quite attractive. We really like, I think I pitched this on before, Gilead, GILD, which I own personally. I also own Ventas personally. Gilead is really attractive here. Gilead is the leader in HIV medication. They also are a leader in Hep C. When they did a massive acquisition of a company called Pharmasat back in 2012. And they did a big acquisition last year on a company called Kite Pharmaceuticals to get them into the immunotherapy world in oncology. The company has a war chest for a balance sheet. Every business that they're in is cash flow positive. They buy back stock. They pay out a dividend. And I would expect that they have another M&A deal in the works. Given the amount of cash that's on their balance sheet that they could put to work. Gilead's not expensive from a valuation standpoint, trades at a big discount to the market. So, I think that's an attractive stock in the healthcare space. But look at healthcare in general. I think healthcare was one of the worst performing sectors in the S&P 500 for the month of February. J&J was down maybe 10% or so. The whole sector has had a rough go.
Yeah, no, that's great stuff. And John, listen, I love when you come on because, again, it's always market specific, right? And so we're able to talk about what's going on with the markets, what happened over the past 3 months, but it's never like, hey, one specific sector. And guys, if they want to get more information off you, I know you mentioned earlier, how can they do it? Because I know you write a lot. I know you show all the videos where you do a lot of media appearances and things like that. And what I love when you're on TV too, because you don't have an arrogance about you, but you just have a confidence and explaining things, which sometimes gets overlooked. Because when you talk about inflation, right, you talk about interest rates, like people fall asleep, they don't understand. I think having this conversation with you and showing why that's important when you come down to Ford, how it can raise prices in trade wars, people really understand it and get it, and then they see the risks in the marketplace. So if someone wants to find out more information, how can they do that, John?
Yeah, Frank, I appreciate that. You can go. We're at Point View Wealth Management, and the website is ptview.com. So, feel free to, check out our website and peruse through the content.
That's awesome. Well, listen, buddy, thank you so much for coming on. And again, I'm going to keep it. I think it was like 4 months this time. We're going to definitely keep it every quarter. I love getting you an update and hearing your thoughts. I know my audience does as well, bud.
Thanks, Frank. And I'll be listening to your bracket picks because we're about a week away when we got to start filling out the brackets.
It's going to be fun this year. Absolutely.
Yeah. All right, pal. Be good.
All right. Sounds good. Take care, buddy. Bye.
Bye.
Great stuff from John. I just love how he dialed down, showed you about inflation, why that's a big deal, why trade wars. And I like having him on because he's not a bull or a bear. He just sees the markets, and he's actually bearish on the markets, right? So you don't have people coming on all the time as bullish or bearish. Not like my next guest is coming on now. He's usually bearish. I was afraid to have him on right now, which is Rich Suttmeier. But this interview, which was taped a little bit earlier, about 15 minutes ago, unbelievable. Fantastic. Please listen to the Fed balance sheet, understand some of the things that, we know how, if you listen to this podcast for a long time, he's a residential bear. He always comes on. He's always nervous and stuff like that. That's why having him on now is great. But I wanted to have not just Rich on and John on, because just having these people on that have a different opinion than you is very, very important. And when you're hearing some of the things that he says and some of the things that you have to worry about, and I challenge him on a couple of things, and he comes up with the reasons why, and they support the reasons. It's really cool because it makes me think. It's going to make you think. It's going to make you dig further, do more research. And when you do that, it's always better for you. You cover every single angle of your investment, of your strategy, where you're allocating. And there's a lot of shifts that are going to take place in the market over the next 6 to 12 months with interest rates rising, the money coming out of some sectors, going out to another. We see that all the time. Money managers, we're talking about hundreds of billions of dollars. And you need to be aware of that because sometimes you have to adjust your portfolio. You can't just close your eyes and say, okay, I'm going to buy this and hold forever and stuff like that. Buy and hold's always been a good strategy. If you bought whenever and held to now, it's been a good strategy. And if that started starting 2 weeks ago or starting 25 years ago, it's been a pretty good strategy. But also, you have to be very, very careful where you're investing, what sectors you're investing in. Rich is going to cover that along with the Fed balance sheet. And let's get to that interview right now. Rich Suttmeier, it's been too long. What's going on, buddy?
How are you, Frank? I'm doing pretty good.
I'm nervous to have you on right now, to be honest with you, because we finally had, after 17, 18 straight months of the market finishing higher than where it started, now we're seeing cracks in the foundation. We saw a 10% pullback and it came back. Now we're seeing a lot of risks in the marketplace, inflation, higher interest rates. I'm afraid to ask you, bud, but what are your thoughts on the markets right now? I know you've been cautious for a very long time and you've highlighted some good stocks to buy as well, but overall, you've been bearish market. How do you feel right now? Are you seeing these risks that you talked about really starting to come to fruition?
Yeah, as this year got going and all my model numbers came out at the beginning of the year based upon the closes in 2017, I thought there'd be some additional upside, but limited. And that happened with the major averages peaking at the end of January. And it went down. It held a key level, so there was a trade back up based upon my work. But now there's starting to be risky levels below the all-time highs, and that for me is a major warning. So we have gone from a sell buy weakness market to a sell strength market with trading opportunities from the long side given the volatility of the market. So you're trading the volatility, and of course, the best ones for that these days are the momentum stocks, the Amazons, the Apples, the Netflix. Those kind of names are the best ones to trade now because they've been providing the leadership. And if you wanted to do that in terms of an ETF, that's the QQQ, and that one tried to break out to the upside on February 27th when the new Fed chief was testifying in Washington, and when they couldn't break out because of what the Fed chief had to say, they was worried about higher yields and the unwinding of the Federal Reserve balance sheet, and therefore that's the catalyst overall that's providing the negativity in the market today. Sure, you have Gary Cohn leaving, and there's all sorts of other things, cross currents that come in. But the bottom line, we are no longer going up on money printing. We are going down on money on printing.
Now, you just mentioned at the last point, I was going to ask you to explain to the non-economists out there, the unwinding of the balance sheet. What does that mean? And I want to really get into the numbers because, Rich, you are by far the best person I know when it comes to analyzing the Fed's balance sheet. I mean, you look at this thing, and it's incredible the information you're giving. This is something that's worried you in the past. I had a guest on.
We're going to be going at a pace of, I think it's by October. They're increasing the number of securities that they're flushing down the toilet each month, and then when it hits $50 billion a month, I think that's going to be in October, and then it stays at $50 billion a month probably through 2020, bringing the balance sheet down possibly as close to $2 trillion from the $4.5 trillion that we started with. So that's $2.5 trillion that's being wasted that could be used for infrastructure spending, healing the healthcare, insurance issues, you name it. And it just really pisses me off that the U.S. Treasury doesn't realize this and that Congress doesn't realize this. They probably don't even know that the Federal Reserve makes $50 billion, $60 billion a year in profits. And you know where that money goes? To the Treasury. So if they have securities maturing, they should just let the Treasury have them. Put the money where it needs to be. We need it in an expanding economy. You cannot have a fiscal stimulus be successful when monetary policy is tightening. It just doesn't work.
Now, talk about the tightening, because the guest I had on earlier was was talking about interest rates, and he was a little bearish short term too, seeing a lot of risks and inflation and trade wars can increase inflation, right? And he spoke just before you. And he started comparing interest rates back to the 1980s when they were, Fed funds rate was 19, 20%, whatever it was, in different periods. However, if it's not an apples to apples comparison because we're looking at our debt significantly higher. And maybe it's close, maybe if you use a percentage of GDP, it might be a little closer, but explain what higher interest rates actually does, because to control inflation and to see where GDP is, and even nominal GDP where it's 4.5 to 5%, nominal just means inflation plus GDP, and we're looking at where short-term rates are, or whatever. Rates should be high. Historically, they've traded a lot closer to that level, within a 2% range. Now we're way off, and why the Fed's so aggressive. But what is that going to do to the balance sheet? And I think that's a question that I get asked a lot. What's going to happen when interest rates get higher with the amount of debt we have in the balance sheet and the Fed and stuff like that? Could you explain that? Because that's something that seems like that really scares the hell out of you.
Well, when you look at what the Fed is doing and hiking rates, that hurts Main Street and small businesses because their rates hike by 25 basis points each time the Federal Reserve raises that rate. However, if you go in and you own a money market fund or a CD at a bank, you don't get 25% more. So that hurts Main Street, okay? And right now, household debt is at a record high, $13.15 trillion, with the biggest rise in percentage terms is credit card debt, now above $1 trillion alone. And a lot of this, like 800 and some odd billion of that, are directly in the banking system among our nation's largest banks, and they're starting to see defaults. And when they see defaults, what do? They send out letters to everybody else raising their credit card rates because they have to offset their losses from the people who can't make the payments on the backs of people who have been making their payments. That is a squeeze, and it's going to be a squeeze. And one other thing that I'm really worried about is if they take this infrastructure spending and tack on a 25% gas or 25-cent gas tax or whatever to pay for it, that's going right to the pockets of the people that are getting tax cuts and one-time bonuses and all of that. And they're paying for it. Main Street is not being helped. They haven't been helped and won't be helped by the way things are going. And the other final point I'll make on this subject is if you can offer out the 30-year bond yield right now is, 3.15% for a round number. You could auction off trillions of these bonds, a 30-year bond, at 4% right now, and you would have more than $7 trillion in the FDIC guaranteed deposits. A lot of that money would go right into those bonds, and that could be used to pay for the infrastructure projects. And you could create these bonds with some features that would be helpful to Main Street. In other words, like using it to pay medical bills, using it to pay student loans, and it would be a source of funds where you could sell the bonds at the market or in special situations always at par. Going back to the theory that we used to have when we paid for the World War II afterwards in bonds known as flower bonds. The last of those matured in 1998, and they had the highest coupon allowed for those was 4.25%.
Now, Rich, what is the actual trigger for this? Because when I hear you say 13.5 trillion in household debt, when I know there's 1 trillion credit card, and I don't know the statistics on a credit card, I haven't looked 1 trillion, but I look at student loans, $1.4 trillion market around there now. But I'm seeing with student loans, even from the companies that I cover, which is Navient, that default rates are going down. More people are paying their mortgage. I mean, is that something to look at where we saw the credit crisis? I'm not trying to scare everybody here, but I remember if you saw The Big Short, because most people read it, but a lot of people saw it, and he said, what's the chances of your subprime or whatever loans defaulting by, I think it was 6%, and he said, we're done. And he goes, zero, and he holds zero. And yeah, but even at that time, we're looking at defaults, and in the housing market, we're still in the single digits. What is a trigger? Do we need to see default rates go higher? And again, I haven't done the research on credit card, but I know right now with student loans and housing, those rates are actually going lower. They're not going higher. So, I mean, what's the trigger for it to, I mean, what do you need to see before you're like, okay, this could be very, very dangerous?
Well, I think the danger right now is commercial real estate. That part of the debt in terms of what banks are holding. Commercial real estate, that's non-farm, non-residential. It represents, the strip malls, the office buildings, and all this other stuff. And if you look at the REIT ETF, that's the symbol RWR, that's in correction mode already. And that's where, the value of property, that collateral for that item on the balance sheet. I mean, if you look at the Federal Reserve balance sheet, I should say the FDIC balance sheet, pardon me, these loans, they're the non-farm, non-residential real estate loans. They represent lending to construction companies to build office buildings, strip malls, apartment buildings, and condos. Now, that hit a record $1.39 trillion in the fourth quarter, and that's up 44% since the end of 2007. So there's never been a decline in that part of real estate lending because it was deemed to be safe. Now it's deemed, I think, probably not so safe with risk of defaults coming up. And that's reflected in the weakness in the REIT ETF. So that's a warning sign for me, a big warning sign.
No, that makes a lot of sense too. We're seeing that where I think it's 50%, I think 55% of all the leases in the mall come up in 2 years. I read something like that. I don't know if that's normal where they take out maybe 2 to 4 year leases or whatever, but and I still see that demand in these spaces where yes, you're seeing less traffic, but when I see people when it comes to mall REITs, not people but companies like Apple and Tesla and even Amazon getting more into big box and opening more stores. I wonder if it's just a transition. I mean, we're seeing a lot of the department stores get more lean and close a lot of stores, but it's going to be an interesting trend. I mean, I don't know if you've done the research in terms of the lease coming up, but I think the next 2 years we're really going to know if, hey, this is going to be really, really terrible. I mean, they're anticipating it, right? The REITs have gotten hit. Do you see it as a buying opportunity later? You still think that, hey, you got to really worry. These things could be in a lot more trouble.
Well, I'm not a buyer of bank stocks, that's for sure. If that's what you're asking. I'm not a buyer of home builders. I'm not a buyer of anything related to real estate, because I think the whole sector is vulnerable. I mean, you have house prices overall at the levels they were at the 2006 highs, and the rise in the prices of homes has certainly exceeded the price of household income, and now with the tax, and you're limited to $10,000 on either property taxes or income taxes, which hurts in many states. That's going to be a problem, in my opinion, and that has been reflected in most of the recent figures on home sales. Existing home sales are down, new home sales are down, single-family starts are down, mortgage applications down. These are things under the surface that bodes a lot of problems right now. I mean, if you look at the 20-city index, that's up 52% since March 2012. In other words, to buy a house in 2012 and now that same house today is 52% higher. Did anybody's income go up 52%? I doubt it.
Yours did. What are you talking about?
Most people on Main Street are struggling to make ends meet, paycheck to paycheck. So any extra little money they get in their paycheck, if it's not swallowed up by the banking system, adding fees to their checking account or raising their credit card rates or their small business loans, it'll soon, that optimism that you see will soon fade away.
Now, Rich, I'm going to ask you.
Particularly if infrastructure spending is delayed.
Which, yeah, probably will be, right? With everything else going on, I wouldn't be surprised. Even though both parties agree that we wanted they both ran on $1 trillion infrastructure policy, right? But yet it's going to be a disaster getting something passed. But I'm going to ask you a really, really tough question. This is going to be the toughest question ever. What do you like?
Newmont Mining.
Go ahead. Mining? Yeah, go ahead.
I said you have to have some gold stocks, and I've been liking Newmont Mining. It still hasn't really regained momentum because gold prices have been kind of fluctuating and not really showing a trend. I mean, you go to the energy sector, that's a graveyard for stocks in the energy sector. The only way you make money in this market is chasing momentum and having a sell stop to make sure you limit your losses once they peak out. If they peak out, this market's in trouble. If Amazon all of a sudden goes down 20% again, or Apple down 20% again, or Netflix or any of these guys go down 20% quickly again, as they did during the brief correction that we had. Some of them went down 20%, maybe 10%, but they could go down 20%, if you know what I'm saying, and that would be the real kick in the ass, so to speak.
And when you look across sectors and analyzing sectors, and I want to finish up here, mining, you can see it's a sector that's been out of favor for how long? I mean, since 2012, minor couple, I think there's more statistics that I think are more important than U.S. sectors, because so many people are saying, well, the foreign markets are cheap and they're doing well, but that's not true. The Nikkei 225 is in correction territory for the year right now, from the year's high, that is. The Shanghai Composite is attempting to rebound. But did you know that the Nifty 50 in India set a new low for the year this morning? I did not know that. No.
Low for the year. Let me reiterate that the Nikkei 225, a new low for the year on March 5th. The Nifty 50, new low for the year, March 7th. The German DAX, a new low for the year on March 2. So people are saying, oh, the global markets are doing great. No, the global markets are warning that the U.S. markets are overpriced.
Good way of looking at it. Now, okay, last question here. Prediction over the next 12 months, where do you see, because you are seeing cracks in foundation, we're finally seeing higher interest rates that people thought would happen 3-4 years ago, and higher inflation, and we're seeing just, like you said, with the Fed balance sheet, there's a lot going on. What are you seeing and how you position yourself? I mean, what kind of correction is it a correction? Is it a crash? What are you looking at maybe over the next 12 months that we need to see before you say, hey, you know what? I'm going to be all into the market and start buying.
Oh, I don't think that's going to be the case, but I say 20 to 40% risk to the downside. Starting, we may have already seen the highs.
So 40% risk, even though, so when I see 40% risk, what I think is that if we go down 20%, the Fed's going to do the same exact thing. I don't agree with it. I don't like it. I hate it. But as someone who tells, is supposed to give investor advice and tries to help people, when I see how much money the Fed made the last time they came into the market and took stakes in banks and backstopped everything, for me, if I see a 20% correction and we still have massive risks where we can go down even further, I think it's like, hey, let's go all in. This is how we did it last time, which means that could be, again, we'll push it down the road further like we do. But that's something, as analysts, we have to address, right? Not that we like it, not putting our personal feelings aside, whether it's politics or whatever, but something that I have to address because I believe that is going to happen if we see something like a 20-25% pullback. Plus, when you see guys like Warren Buffett with $100 billion on a sideline waiting for this market to come down, we're seeing a lot of like trillions come back into the market in from repatriation and stuff like that. It seems like we're going to see a lot of opportunities where it comes down. Maybe people are going to come in and buy the market here, no?
Well, I don't think Warren has had a couple of good trades here. He's selling IBM at a low and he's buying Apple at a high, and that's not his usual style. So I think his younger potential heirs to the management of Berkshire Hathaway have gotten into his head a little bit. So everybody's looking at trading like Buffett or investing like Buffett. He's not being Buffett lately.
So that's great. It's great because you're exactly right. There are certain things that he's doing right now that's not really traditional that I've seen do in the past. So, okay, so we'll end with. I hate ending like this. I really do. I'm trying to get a little bit of a positive.
Wait, what do you want? What do you want?
Give me a stock pick or something, whatever. Come on, you can't end like this. The market's gonna crash 40%. I'll talk to you later. No, but listen, I'm kidding. Listen, that's how you feel. That's how it is.
You cannot unlike Amazon for trading reasons.
Mm-hmm.
I mean, it's a momentum trade. It's not ending yet. Just remember that when it ends, it's going to go down 10% quickly. So, if you buy it and it reaches your target, sell it. Then wait for the next one. This is a market of going long on weakness, stocks that have a history of popping back and setting new highs, which is your Amazon, your Apple, your Netflix, your Facebook, all of the obvious momentum names. Those are the ones you trade. But there's nothing that's really a portfolio holding for the longer term now, except, you need a gold stock or a gold investment for maybe 10%, and then you're 40% in cash, and the rest of it is your long-term holdings that you've had for years. And what's interesting is if you look at utilities, remember I liked utilities, then I didn't like them. I didn't like them when they got to a 3% yield. Now utilities are a 4% plus yield. So it's time to look at some of these dividend plays. The dogs of the Dow have been horrible, so look through the dogs of the Dow. You have a 5% yield in Verizon, I believe it's close to 4% in the two energies, Chevron and Exxon. So that's the kind of thing. It's time to look at maybe you want some dividend plays in here. Dividend stocks, gold is, I think, the balance of your portfolio now, and trading the momentum names. That's the way you trade at night right now.
Yeah, that's great, Rich. And you brought up a very good point to end here where which I thought was very interesting. We're always like buy the dip, but maybe it's not, hey, you know what? Yeah, we bought the dip when we down 10%, but it's interesting to say, no, maybe it's not we're buying the dip anymore because now we hit the highs and we're selling off. Maybe it's selling the strength here. So it's interesting to see if that trend continues, everything going on. But Rich, I love having you on. I love going over the Fed balance sheet. I love, I learn from you every time I talk to you. And even though we have different opinions, that's why I love having you on. I always tell everyone, listen, if you're bullish on the market, talk to someone that's bearish. If you're bearish, talk to someone that's bullish because it's going to make you dig even more and do more homework. And you always do that every time I'm on with you. And I appreciate it. And I know my listeners appreciate it, bud.
Okay, Frank. I always enjoy talking to you.
I appreciate it, man. Listen, I'll be in touch, and I'm sure if anyone wants to learn more about Rich Suttmeier, where do they have to go?
would go to the maven.net. That's my really home base. I have been writing for Seeking Alpha. I have been writing for Investopedia, and I've been writing for Forbes.com. So you can find me in those 4 places. Google my name, and you'll find me.
All right, sounds great, Rich. Thanks so much for coming on. I'll talk to you soon, all right?
Yep, take care, Frank.
Take care. All right, guys, 2 good interviews. What did I take away from them? So hopefully it could help you in the way I'm thinking, where talking about commercial real estate was a big deal. Remember, we didn't see a large percentage of residential mortgages and mortgages in general have to fail before we saw a massive crash in that market, right, during the credit crisis. Commercial real estate, because when he's saying credit cards, and again, I haven't done the research credit cards, when I look at 13.5 trillion housing, I see that as a stable market. Default rates are okay. They're fine. And that's why I was asking for the trigger. The student loan industry, I cover a company that is the biggest provider of student loans, biggest owner of student loans. Default rates are going down. Statistics show. This company gets picked on all the time. It's an easy target for politicians, right? What I have to do is argue about student loans. There's too much debt, and here's a stupid company, and everyone's going to kill a guy. It doesn't even matter, right? Every student's pissed off that they have debt, even though they should take a little bit of responsibility for that. Just a little bit. Take out tons of debt, go to educate, have that education for 4 years, right? You did fill out the paperwork, you did everything. Yes, some people got screwed a while ago, and I get it, but it's an easy target. But bringing up commercial real estate was interesting. Going over the Fed balance sheet was interesting. Rich talking about trading, and at the end of that interview with Rich, it wasn't I was trying to change his opinion or joke around and stuff like that, but for me, it was kind of like, what is good? I wanted to challenge him a little bit. Okay, if we see a 40% decline, which I don't think we'll see because the Fed will step in if we have a 20, 25% decline. They made money the last time on everything that they did. The panic, I mean, look at the panic we saw with a 10% correction, which 2 weeks later came back. The panic that we saw. Volatility, crazy. Imagine if we go down 20, 25%. I forget it. The headlines, the papers, social media, how fast things spread today. I mean, I had someone who's very, very smart and I admire very, very much, who's a bear, who's actually a money manager that I worked with at one time. We're down 8%, and he was putting out things that were laughable. I actually called him on Twitter. I make fun of him. I like him. I have a lot of respect. He's a great guy. He's very smart. But saying that, the Fed could come in, and J.P. Morgan saying that the Fed could come in, on this pullback, and they need to inject money or whatever. And I'm hearing rumors and stuff like that. And I was like, listen, come on. I mean, I called them out on Twitter. Could you take it easy? I mean, the market's still up. So whatever it was, it declined in February. The market was still like up a little bit, 0.5%. I'm like, we're still up for the year. Take it easy. Not there yet. But if a guy like that, who I consider very smart and a very, good analyst, decent analyst, it could get that shooken up over a 10% correction, what's going to happen at 20, 25%? And you have to factor that in. I don't care if you hate it. I don't care if you believe it. Because I had that problem in 2010 where I'm like, man, I can't believe the Fed did this. I can't believe, they should let banks fail. And then, I listened to David Tepper come on CNBC, and he said, listen, guys, the Fed's backstopping everything. There's no risk. He goes, you know what's going to go higher? Everything is going to go higher. And I just was like, man, that's 100% right. So instead of focusing on the wrong things, you want to see where stocks are heading, what's going on, and the fact that inflation, I mean, that was great what John explained, right? Because, hey, we all see inflation, that's a risk, but with trade wars and some of the things that we have could spark a much higher inflation, which I don't know if that's factored in, right? That's where we're seeing the market come down a little bit on these trade wars. Now, Cohen resigning. So that's what I took away from the interviews, looking at that. It makes me want to research more. Even if I have different opinion, I respect everybody. That's how you want to look at the markets. And I can tell you something about Rich, because sometimes Rich is always bearish. He's been saying the market's going to come down. How interesting was it what he said about 6 months ago? He's like, you want to hear something good? You want to hear something different? He goes, Amazon. They're probably going to get into healthcare and all their Prime members. And I mean, nobody was talking about healthcare for Amazon. Nobody. I was like, that's a pretty good idea. Look what happened. They're getting into healthcare. So you look at every interview, every person, just because if you don't believe or you don't have the same opinion as them doesn't mean that, hey, everything that they say I'm going to disagree with, or you think that person's terrible or an idiot or whatever. And that's what I try to do. And it makes me dig even deeper if they have a different opinion of me, which is always better. It's always better to do more research, double check, triple check. That leads to more winners for me. It stops me from having bigger losers. And hopefully that's what you took away from those 2 amazing interviews today. Okay, guys, check out my Curzio Research Facebook page. I'm posting live videos on it all the time. I didn't do any this week. It's been very, very busy. I have some of my team members here, which is really cool, but I'll post one later today. What's going on, Colin, my opinion and stuff like that. I love doing the live stuff. Just, hey, make a mistake, you make a mistake. You don't. It's a lot of fun. But it's real. You see me out. Sometimes I'll be in a T-shirt. I just worked out. I'm in the office. I work all day. So it's kind of like, just having fun, and it's cool. So, it's you're going to get really good detailed analysis, really great stuff. Talking about the department stores, which if you listen to some of those videos were fantastic. Good timing. Saying, hey, Macy's looks great into the quarter. Low expectations. Watch out for Walmart. Watch out high expectation stocks and stuff like that. But also on the Curzio Research Facebook page, everything's for free. I heard people say, well, Frank, I don't use Facebook. You can have a Facebook account and just look at other people's things. You don't have to have a Facebook account and have to post stuff and friend everybody or whatever. So, it's just a good outlet that really gets our brand global and gets everything out there. And we like to provide a lot of free content because right now we're at the stage of growing our business because everyone that knows us, a lot of you subscribers already, and that's how we grow our business. But to grow it even further and take it to the next level, you got to go to people who don't know our brand. And that's why I like providing free stuff like this podcast and also that things on Curzio Research Facebook, which we also put a weekly breakdown on. You take the best stories we think, best stock stories, and you get all that stuff for free. If you're on an email list, you get that every week. And it's a good read. It's fun. I just read tons of stuff. It's something that I would want. So we get a lot of compliments on it. I was like, wow, I wish I could just filter out some of this garbage and just put in like a good 10 stories at the end of the week that are important, that are interesting, that can make you money that no one's talking about. And that's what we do. And you have, all in one spot. So it's really, really cool. Be sure to check it out. Be sure to comment. I have people saying positive, negative stuff, which is cool. I don't mind at all. But it is a way to introduce us to people who aren't familiar with our brand. That's why I like Facebook. And that's why, we do this podcast too. So yeah, definitely be sure to check it out. And guys, that's it for me. Thanks so much for listening. Always appreciate your support. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.